Hello viewers, welcome to Stockbox, the place where you get your investing knowledge on an simplified and an easily understandable words. Yes, what is candlestick? And what are the different types of candlestick? How to use them in live market? What are the characteristics of each candlestick? And yes, if you're fairly new to stock market, please do watch the previous basic videos for better understanding. So let's get started. Candlesticks originated from 18th century by Japanese for rice merchants and traders to track market prices and daily momentum. A candlestick is a type of price chart used in technical analysis that displays the high, low, open and closing prices of a security for a specific period of time. Candlesticks can also be called as bulls and bears. It simply means buyers and sellers in the market. If you see a long green candle forming, it represents buyers are now in control. If it's a long red candle, it means sellers are controlling the market in that specific time frame. On the diagram below shows the wide part of the candlestick is called the real body and tells investors whether the closing price was higher or lower than the previous price. The candlestick's shadow, or in other words wick, shows the day's high and low and how they compare to the opening and close of a price. Candlesticks can be used by traders looking for chart patterns. And here in the diagram, the highest price of the day and the lowest price of the day has a shadow or a wick, and the opening and closing price has a wide body which can be red if the day's closing is below the opening price and can be green if the day's closing is higher than the opening price. On simpler words, a candle can represent the day's movement on either side on a specific time period. This might be a little technical on the first go, but go through the video once or twice, you can get the concept. A candlestick's shape varies based on a relationship between the day's high, low, opening and the closing prices. So here are the two main candles, that is the bullish candle and a bearish candle. When a stock opens at rupees 100 and closes at rupees 200 within a specific time period, that is a bullish candle. Whereas when a stock opens at rupees 200 and closes at rupees 100 again with a specific period of time is called as bearish candle. On the diagram below, you can see a bullish candle opens at rupees 100, goes up to the day's high for 250 and comes back low for rupees 50 and again closes at rupees 200 with a wide body is called as the bullish candle. Whereas on the bearish candle, the day's opening is on rupees 200 and it goes up to 250 and comes back low to 50 rupees and again closes at rupees 100, wherein that represents a bearish candle. And here the bullish candle represents the buyers are in control and the bearish candle represents the sellers are in complete control on that specific time period. Now we know the basics of candle. Let's see different types of candlesticks. Number one, doji. In Japanese, doji means the same thing, referring the rarity of having the open and close price be exactly the same. And doji represents indecision on both the side, buyers and sellers. Everyone is equally matched, so the price goes nowhere. Buyer and sellers are in a standoff. Doji candlestick forms when a security open and close are virtually equal for a given period of time and generally signals a reverse pattern for technical analysis. Below we have two diagrams on which one you can see the open, the close are almost on the same price, whereas the high and low has a huge volatile wick. Now that represents normal doji. Here on the other diagram you can see the live market example of the presence of a doji, and you can also see various types of dojis at various different specific time locations. So there are different types of doji candles. One of them is dragonfly doji. The dragonfly doji is typically interpreted as a bullish reversal candlestick chart pattern that mainly occurs at the bottom of a downtrend. Dragonfly can mean that bears were able to press prices downside, but an area of support was found at the low of the day, and buying pressure was able to push prices back up to the opening prices. The long lower shadow impulse that the market tested where demand was located and found it. On the diagram, you can see the opening price was pushed down and found a support at the low of the day and was pushed back by the buyers to the opening price itself. That simply means the buyers are in control after the prices was pushed down. So that represents a dragonfly doji. Few key points to be noted. When a dragonfly doji accompanied by a higher than usual volume is more reliable than one with the lower volume. And a successful trader will typically wait until the following day to verify the possibility of an uptrend after dragonfly doji. And the dragonfly doji are very rare since high open and closing prices are rarely ever the same. Below there are two live market examples. One of them you can see that there is a downtrend on which there is a dragonfly doji formed on the lowest candle. That is a strong signal of a reversal, and after that point you can see there is a rally on the upside. On the other diagram you can see multiple dojis and one among them is a prominent dragonfly doji there. After a consolidation you can see slowly the prices go up. Between these two charts you can see one has a prominent uptrend after the dragonfly doji. That is because there is a strong buying candle followed by this dragon doji. But the other one had a consolidation before moving up the order. That is because the followed candle was another doji that itself is an undecision move by the buyers and sellers themselves. The second type of a doji is a gravestone doji. As any other candlestick pattern, the gravestone doji can occur anywhere on the trading chart. Though the highest potential usually takes place when this formation occurs at the highest point of the bullish momentum, representing the fact that the buyers tried to push the price higher but were unable to hold the achieved levels. Therefore, the prices dropped and formed a wick. It is recommended to ignore the presence of the gravestone doji candle in the ranging market. That means when the price is moving on a sideways, because the market still stays in some indecision locally, not giving any valid signs of further price momentums. Here in the diagram you can see the price was opened and went up to the day's high, but it could not sustain the day high and it was pushed back to the day's low. That represents a gravestone doji. It simply means the buyers were controlling the market at the initial stage but could not sustain the market and and the price was pushed down by the sellers and came into complete control. Few key points to be noted. Gravestone doji's appearance at the top of an uptrend momentum signs a potential reversal. The upper shadow of the candle represents the local capitalization of the buyer. Hence, traders start losing confidence in the continuation of a bullish trend. The negative aspect is that the gravestone doji is a fairly rare candlestick pattern. Like all other patterns, the gravestone doji does not generate 100% accurate signals. The reversals may be very small or last a very short period of time. On the below two live market charts, one chart has a prominent reversal from a bullish momentum. But on the other one, you can see there is not exactly a resistance at that point of a chart. So it took a consolidation before moving down. And there are single, double and triple candlestick patterns which can be used to make a profitable entry and exit on live market. And yes, hope you understood the basics of candlestick and its uses. I'll post more such videos on various other candlestick patterns on the next video. Well, if you found yourself lost at any point of the video, please do comment below. I will get back to you. Please do like and subscribe. And yes, until the next video, have a great day.